Hey folks, how's it going? Good morning. Sorry,
Good.
afternoon.
Hi, Alejandro. How are you? Thank you so much for being here. We're really appreciate it. And I think all the students are looking forward to your presentation. So
Likewise.
with that being said, I'll leave you with the floor.
Awesome. Awesome. Thank you so much. And maybe maybe a little bit of context also would be great. Learn a little bit about the students. I don't know if folks want to share anything, maybe some background, but would love to hear a little bit more about the audience.
Okay, so we are doing a business plan competition with students from 4 universities: NMSU, Tec de Monterrey de Juárez, UACJ, and UTEP. And the idea is for it to be a collaboration. So most teams have either participants from each university or at most 2 participants from one university and the rest from other universities. So the idea is for them to be able to network, to meet each other, to understand different perspectives from across the border. So I think it's an amazing opportunity for students to be able to participate in this. The idea is for them to develop a product or service that will address the needs of our binational community.
Wonderful. That's awesome. And students, good afternoon. Thank you so much for being here. Actually, a question really quick. Does anyone want to share maybe some of the ideas that you're working on? I think that'd be super great and see if I can be helpful and get an idea of the types of problems that you're trying to solve. You can't be shy if you're gonna launch something, guys, okay? So if not, I'm gonna pick on you. Maria already turns off her camera. I'm gonna pick on you, Maria Fernanda. You go first.
We
You're on
can't hear
mute.
you, Fernanda. But we can't hear you.
Sorry, I had to leave because they were making a lot of noise. That's why I turned off my camera. But hi, Professor, how are you?
Hi,
Doing
Fernanda.
well, thank you.
That's good. So we haven't decided one yet. We are in between two. We're trying to see if we can maybe do like a student fast pass for students that are crossing from Juarez to go to the University of Texas and to NMSU. I know how in the mornings they do have that fast pass where students can go first and also workers.
Yeah.
But we wanted to like combine an idea that be something more a little bit more advanced. And we were also thinking like a digital platform like for students from the OACJ and MSU, DIC and UTEP to have discounts in like the small businesses here in El Paso or like where they want to buy things. So we're still figuring it out, but we're mainly prioritizing towards an app for students.
Super.
Yes.
That's awesome. Thank you for that. Maybe someone from Tec de Monterrey. Actually, I was there in high school, so it's been a while since I've been back to campus, but anyone want to share?
Sorry, what was the question again?
Hi, Jesus. Good afternoon. Just learn a little bit more about the type of company or idea that you have that you're thinking about.
Well, we investigated a little bit about healthcare business that are going around in the border, and we find some interesting things about a cancer hospital, and we are like thinking about a healthcare insurance or something similar to develop for the people in Juarez and El Paso and Texas in general. So we're looking into that.
Super, super. And also, I mean, also trying to get these, because if then you think you really want to pursue this at some point, like see if I can be helpful and make any introductions in some of these spaces. Awesome. Well, I mean, well, thank you so much for that. I'm excited. I will hear more from you. I'll be joining for one of the judging sessions, I believe. I think the first round. So excited to spend some time with you all. A little bit about me. I'm originally from El Paso. I'm a UTEP grad, but I'm originally from Juarez. I started my career in investment banking, focused on tech. I got to work on the Facebook IPO. So that dates me a little bit, but it was a very different time back in 2012. The Facebook had just come out with the app. There were no ads. There was no Instagram. So very different world, but that got me hooked on the tech world. From there, I went on to work with former Mayor Bloomberg and his strategy team at his tech firm. Spent about 5 years doing a lot of things there, from M&A to integrating those companies that we bought out, to helping develop product, commercialize, integrate new technologies. So that's, back in 2013, I got an early start on crypto, got an early start on AI. So anyway, that was a ton of fun. From there, I got my MBA, and after that, I've continued to operate, in the tech space, primarily doing fintech startups and things related to supply chain and logistics. The last startup that I was a part of, I joined very early, very early on, to help them build product. Became the CFO. We raised about $100 million for that business to scale in Mexico, Latin America, and then the US. And then we sold that business early last year. That's when I returned to El Paso and Juarez. I'm currently a professor of practice at the College of Business, where I teach 3 courses there. And I'm also in charge of all the programming related to entrepreneurship, right? So if you want to learn more about what we're doing, please reach out. And on top of that, I also have an investment fund called No Border Ventures. Our investment focus is on early stage founders, so pre-seed, seed stages. If you don't know what that means, I'll talk a little bit about that in a few minutes. Early stage founders that are based out of the Southwest and mountain region of the US, and then anything cross-border, right? We're industry agnostic, investing checks of anywhere between $100,000 to $250,000. What else can I say? And yeah, really excited to spend some time here today. I think the reason why I'm here is to give you that, that perspective from an investor, to let you know, like, what are the things that we look at, teach you a little bit more about what the venture capital and investment world looks like, and fundraising and what that means. And hopefully, you'll get some takeaways, and hopefully this also helps you, not just for your presentation, but then as you continue to go forward in your, entrepreneurship experience. I know a couple of familiar faces here, so if there is some of this that you've seen in the past, hope it just helps to hammer the point. If not, well, I hope you enjoy. So let me start off with this presentation. There we go. All right. Okay, can you let me know if you see my presentation? It's on? Awesome. All right. So I'm gonna start off with, before I begin and talk about, the intricacies of, like, the fundraising and investing side, I always like to start off with a little bit of history and explanation as to the asset class that we're looking at. Why startups, right? Because everyone always hears about, launching tech startups and raising a ton of money and a lot of risk, and everyone listens and hears about the glamorous side of being a founder, but it's hard. It's hard to be a founder, right? It's normal to, break up with your co-founders. It's normal to pivot, that the ideas that you originally had, you have to switch them and change them. So it takes a lot of passion, right? And with that said, I mean, it's also a very rewarding space, right? So venture capital, yeah, it's highly risky, but it's less risky than investing in a restaurant, but still very, very risky. And it can bring a lot of returns to investors, right? So definitely, out of the asset classes that most investors, look at, it's definitely on the higher end when it comes to risk, to the risk and return profile, right? Just as a heads up, like 80% of startups fail within the first 5 years. So investors really, the way that we make money, is let's say of the 20 companies that I invest in, about 16, 18 will go out of business, and then I'll make money from the rest, right? So yeah, the returns, very few make it, very few win, right? And if you're not prepared for that experience and the grind of 7-10 years, it's very unlikely that a startup will survive. Okay. Just hammering the point, in terms of returns and what returns have looked like over different periods of time, but venture capital outpaces basically every asset class when it comes to returns, right? So you can, it's a great place to invest in, of course, but you also have to be very careful as to what you invest in, right? So the big picture, I mean, all the companies that all the big companies that you hear about today, like the Ubers, Googles, Teslas, Microsoft, they were all startups at some point, right? And they required investment to build their dreams. They're very different companies than what they are today. They started off with something very small and niche, and now they're serving the mass consumer, right? And I don't think I have this slide here, but the reason why we have entrepreneurship is that over the last 15, 20 years, 50% of the Fortune 500 companies have disappeared, right? And so the big companies that you see here, they might not be around in 10 years, right? 10, 15 years. It's hard for companies to maintain a competitive advantage and continue to innovate. Actually, there's only one original Fortune 500 company that's still in the Fortune 500 that still exists. I don't know if anyone here wants to take a guess as to which company that is. No takers? I don't mind uncomfortable silences though, so I can
Would it
wait
be
a minute or
Apple?
two. No.
No.
No. Anyone else have a guess?
Maybe Uber.
Nope.
Maybe
Re- re-
Microsoft.
Going back, only one. I mean, think about it, there were 500 companies in the original Fortune 500 companies. Only one of them still exists today. So it's older. One more guess.
Be Amazon? No.
No, Amazon is too young. No, so the only Fortune 500 company that exists from the original is General Electric, right? And that goes to tell you, I mean, it's a massive company and it survived, for more than 100 years, right? And the only reason why it's been one of the companies that's been able to maintain, and reinvent itself, be competitive, and find ways to survive and stay in the eyes of the consumers, right? And that's extremely hard, and that's the reason why startups exist, right? Because consumer tastes change, technologies change, and that's why there's always an opportunity to compete against the big guys, right? They get comfortable, they lose, they lose focus, right? So that's why startups matter, right? Okay. So really quick on history, venture capital and investing in startups, the model has existed for a long time. It goes back to the period of Christopher Columbus and the Spanish throne, when Queen Isabella, that they hired Christopher Columbus to go out and find the West, find the Indies, and he ended up finding America, where the profits that or the riches that Christopher Columbus would find, 80% would go to his investors, and then the 20% would go to him. right? Same thing happened in whaling in the 1800s. And then it started to evolve. We started to get General Electric. The first investor, the biggest investor in General Electric at the time was JP Morgan as an individual. So he was the OG angel investor that decided to support Thomas Edison, helping him. He bought about 100 of his light bulbs, put them in his house and showcased it to the world, right? And so anyway, the venture capital model has since evolved, right? It became an established industry in 1946 after Professor Doriot from Harvard Business School went around, raised money from different investors and invested in a startup that returned, about 3,700%. So everyone became really rich really quickly in the span of like 3 years. And so that's when, the venture capital model was born, right? So now we've gone through several rounds, the days of the internet, the early 2000s, and now we're going through the AI revolution, right? So quickly there. Now, a little bit of history, and this is relevant for you if you're looking to become a founder full-time at some point. Here, what I'm showing is the amount of money invested into startups, since 2006. So if you see, it seems like a pretty, normal growth, you could say, up until something happened here in 2018, right? All of a sudden, huge growth, about 30-40% of growth in startup investment. And all of this is very relevant because you need to understand what the market looks like and see if you're going to be able to raise money or not, right? So you have to be very, very cognizant of what investors want, right? So between 2018, 2019, the reason why, so much money went into funding startups is that the U.S. economy was doing extremely well. It was growing really, really fast. It was growing at 3.1%, fastest pace for any calendar year since 2005, right? Unemployment was very low. And there was a regulatory change where retail investors were allowed to start investing into startups. So, these crowdfunding sites, popped up that allowed, non-professional investors to get exposure to startups. So this happens. I mean, every time things are good, people start taking more risk, right? So this happened initially 2018, 2019. And then 2020, you see this huge jump now here between 20 and 2021. Well, we had a little something called COVID, right? Which through all the supply chains, through the world turned the world upside down, and all of a sudden, these shocks wave in the market created a lot of uncertainty. So the government reacted by sending interest rates down to 0%. And I don't want to turn this into an economics session, but it's extremely important and relevant for you to understand what the market means to you as a founder. Because with interest rates going to zero, a typical investment portfolio or someone that's trying to, mimic the S&P 500, you're happy with a 10% return on an annual basis. And so typically, you would invest a portion of money in bonds and another portion into your stocks. And if bonds, let's say, were at 4 or 5%, you only needed to take, a moderate amount of risk to make that other 5%. All of a sudden, bonds went to zero, right? So you had to make that 10% somehow. So all of a sudden, people started to take more risk and they start to invest a lot more into startups. So all of a sudden, what happens here? A lot of money comes into the startup space. Valuations were really, went extremely high. So company, and you could raise a lot of money. So you didn't need to put a lot of effort into fundraising here, right? You could have a pitch deck, an idea, go to investors, and it was like, okay, yeah, I'll give you $1 million, right? That's not the case anymore. that's not the case. That bonanza went away, right? Because just as startup valuations inflated, so did the rest of the world, and that caused inflation, right? So all of a sudden, to counter that inflation, there was a reversal on that 0% on interest rates. And all of a sudden we went all the way back up to 6% again. And so now you can make your 6%. Well, I'm gonna take very little risk now to make up that other 4% to get to my target return. So startup investment went significantly down, and that's been the story for the last 4 or 5 years. So it's really hard nowadays to raise money, right? And you have to be very cognizant that investors want a lot more and a lot more focus, right? And so we're going to get into that. So that's what the rest of the session is going to be about. Tell a little bit more about what investors are looking for, how you should be thinking about, your presentation. But anyway, just wanted to set up the conversation and give you a little bit of history that I hope will be very beneficial as you move forward. Okay, I'm gonna skip all this stuff here. Right. There we go. All right. So yeah, I'm gonna skip this part too. So I think this part is relevant. Who can invest in your startups? So there are 2 types of investors. There are accredited investors, right? And non-accredited investors. Accredited investors are folks that have no limit on how much they can invest, right? These are primarily high net worth individuals, right? Or folks with that reach certain that are above certain minimals that are required by the government. Other than that, not accredited investors have limits on how much they can invest on startups, right? And these are many times the folks that you'll find on crowdfunding platforms. But other than that, accredited investors will typically be like the angel investors, the venture capital firms, and whatnot. Okay, some of the reasons as to why folks will invest into startups. Well, some folks will want, to diversify their portfolio. They might be looking for, the long-term return potential. They probably understand an industry really well, so they want to stay connected to it. They believe in, the founder's idea. They want to stay up to speed as to what's happening with new technologies or new businesses. And you also get some interesting tax benefits by investing in startups. More talk to your accountants more on that. So let's get more into it. The stage at which you're at, I would call it the product market fit stage, right? It's early, you have an idea that eventually will turn into a prototype, eventually will turn into a product, and eventually you'll start to build a business. Now, once you build a business, right? Do I have a pointer here? Let's see. Okay, cool. There we go. So once you build a business and you have a recurring, model that you can scale, that's when you go into Series B and Series C, where you really, okay, now you've proved out the model. Users love what you're doing. You don't need to spend a lot of money to acquire these consumers. They come to you basically because they can't live without your product. And now you need to scale that business, right? So once you scale that business, then you go into a growth stage, which is the type of growth that can allow you someday to do an IPO, maybe, or have a big enough company that you can sell to a bigger player. Okay, but right now the focus of this conversation and where we're at is going to be right here, right? Who do the startups typically raise capital from? I mean, all the way at the bottom, lines of credit and loans for the startup space are actually quite difficult. So they're not going to be scope in this presentation, but you can raise money from different places, right? There are these crowdfunding models, angel investors. I'll skip on syndicates because it's a bit of a combination. And then finally, the VC fund, right? By the way, this presentation, I think I've shared it before with Nicole and the team, so they can also send it to you so you can have it as reference. But here, basically, what I try to lay out is, what's the difference between debt, VC money, and angel investors? So, because and this is going to be part of the presentation of a couple of minutes is coming up, but how much money you raise is important, but equally as important or even more important is who you raise money from, right? Whether it's ideally at this stage when you're extremely young and it's a very nascent idea or business, you should be looking for angel investors and not professional investors. You should be looking for angel because these are folks that have extremely high risk tolerance. They know their money might go to zero, but they that they want to build a relationship with you. They want to help you out. They can give you a lot of support early on. When you're a bit more mature, that's when you can go for venture capital money. Okay. Here he goes. So from whom you raise is often more important than the terms. Because sometimes most ventures end up taking more time and more money than the entrepreneur ever imagined, right? So if you thought you might only need a little bit of money, you actually probably gonna need more. But anyway, I'm gonna skip this slide real quick. Okay, so let's get a bit more into it. So folks tend to say that time is money. In the startup world, you have to flip that saying. In the startup world, money is time. So you're really raising money to have time so that you can scale, you can try experiments out, so that you can validate experiments, right? So at this stage, when you're raising money, you're raising money to buy time so you can figure things out, right? So you go out and tell them, potential investors, hey, with this money, I'm going to reach these milestones, which should set me up so that I can go out to the market with a more de-risked idea, de-risked product, de-risked business, and then raise more money. And this is what it looks like, right? Over time, this is, you can raise a little bit of money. Okay, this looks better. Okay, now I can go and raise some more. And that's typically what the process looks like, right? At each stage, you're trying to prove something out. At the same time, you're scaling the business. At the same time, you're taking risk out of it. And that's why you can raise more money. All right. So think of it every time you raise money as, can I raise the least amount of capital to make some experiments and make them work, right? Because typically what happens, right? Right now you're coming up with an idea, you have some hypotheses, and at every stage of funding, you'll learn things, right? You'll either say, hey, I might need to make some adjustments to what I'm doing because this is not exactly working how I thought it was going to work. This is not exactly what the customer wants. Maybe the company will die, and that's typically what happens. Or you might say, hey, I think I hit jackpot here, and customers love it. Financially, this makes sense. Okay, we can move on and go to the next stage, right? Now, let's get into talk a little bit about this cash. So once you have this cash, as an entrepreneur, you should understand three concepts. Primarily, one, the first of the most important, of course, is always have an idea as to what your cash balance is, right? This is more important than net income. Net income doesn't play doesn't play a part in startup finances. Because first of all, you're not if you're growing the startup, you're probably not generating any net income, right? You're actually burning money, right, every month. So tracking your cash balance is extremely important. Understanding what understanding cumulative cash flow, and then how much you're burning on a monthly basis, right? So when you go out and raise money, you're raising enough cash to survive for the next 12, 18 months, ideally 2 years, if possible, right? So when you think about projections, and we're going to get a bit into that, right? These definitions, I'm going to leave these here, but they have to do with how you should be thinking about cash or cash flow, right? Who does everyone here have any background in no, better asked, anyone here doesn't have a background in finance or accounting? Can you raise your hand so I have an idea as to how many folks don't have it? Okay, one. Okay, so it seems like only one of you that doesn't have the background. Okay, so ideally you should be able to follow me on this. Let me go back to my presentation. There we go. What I'm showing here is it's a P&L, right? Adjusted P&L that basically modifies, your typical, everyone knows like revenue, you get to your gross margin revenue, how much money, how the sales, gross margin, minus costs, and getting to your operating margin, right? All the way down. What I'm doing here is I'm adjusting this to try to reflect as much as possible what the actual cash is that your company's generating on a monthly basis. So yeah, you might be tracking, it's important in your projections, right? To show investors, hey, this is the revenue that I'm hoping to generate. These are the costs, right? And yeah, I mean, all they're going to see is negative, net income. But what you need to show as well is how much cash are you actually burning. Now, some of you might say, what's the difference between my net income and cash? Well, there's a huge difference, especially when we're talking about, if you take into consideration working capital or non-cash expenses. For example, depreciation and amortization, you're not actually, money is not, actual cash is not coming out of your business when you account for depreciation expense or amortization expense, right? Furthermore, the way that you manage working capital also matters substantially. And I'll give you a quick example. Let's say that I am producing avocados in Mexico, and I'm exporting these avocados, and I'm selling these to Walmart. I'm selling these to H-E-B, right? I'm selling these for $100, right? I'm selling these for $100, but you don't get those $100 right away, right? So on the books, it might seem that you have $100 of revenue, right? But that's not really the case, right? Why? Because Walmart and H-E-B and these big players, they're not going to pay you day one. They're going to pay you 90 days out, 120 days out, right? So that means that money is not coming in. Actually, let me put up an Excel, I think, just to hit the point. Revenue, cash, expenses. can you see my Excel or not? I think you probably can't. Let me switch it. Okay. So let me make this right here live with you guys. So you sell $100, right? But this is month 1, month 2, 3, month 4, month 5. All right. On the books, you sold $100, right? But that cash in, doesn't come in until here. In the meantime, you have a ton of expenses that you probably have to pay this month, right? Because your employees are not going to wait. Your employees are not going to wait 3 months for you to get that money, right? For you to pay them. So you have payroll, you have to pay rent, you have to pay, you have to buy fertilizer, you have to buy a bunch of things, right? So these expenses, right? Net income. These expenses come out to $80. So net income, yeah, you're making some money, which looks great. You're making $20, but in terms of cash, in terms of the lifeblood of your business right now, cash in 0, cash out 80, cash net -80. So when it comes to the startup world, cash is what matters. Do you have enough cash to survive, right? Because on the books, it seems like I'm making money, but you're actually losing cash. So working capital is extremely important as to how you manage, your company. So that's why tracking cash in your business, especially early stages, is the most important thing. So with every projection that you show an investor, don't only show revenues and expenses, but also show how much cash you estimate you're going to be burning or making each month. Any questions on that until now? Feel free to jump in or raise your hand. All right. So everyone understands that cash is king in the startup world. Okay, no reaction, so I'll move on. Okay. Let me go back to my presentation. Share. Great. Cumulative cash flow is basically, it's just understanding cumulatively, over the months that you've been operating, how much cash have you made or spent over the lifetime of your business. So that's it, and it matters, so you can understand what your break even is going to be, right? So, hey, I know that I've, my cumulative cash flow for the last, year has been, in this case, negative $1,200. I'm sorry, $2,100. So I know that I need, over the next X quarters, I need this amount of money so that I can get back in the black, right? So anyway, this is just to drive the point, but this is there. Here's just a way, to graphically show this. What during the first years of a startup, you're primarily burning money, right? Until you start to become cash flow positive, which means you're stabilized. Ideally, you want to get to a cash flow positive state within the first 2 to 3 years, because that gives you more control. Now, this is important. The faster you get to this cash flow positive stage, you can now have more control on the future of your company. Because let's put into perspective, if you're a company, you raised let's say you raised $1 million, right? And every month you're burning $100,000. That means you have, about 14, 15 months of runway before you die. Well, if you start to make money by month 10, you can start to stretch that money out, right? You can survive for longer before you go out to the market and try to raise money. Because guess what? Every time you go out to the market, you're going to be giving up a portion of your ownership. And we're going to get into that, towards the end of the conversation, but it matters, right? It matters because if an investor knows that you're going to run out of money in 2 to 3 months, hey, I'm going to give you very bad terms. Well, very favorable terms for me as an investor, right? But I'll give you really terrible terms, right? So the faster you can get to, a cash flow positive state, the more control you're going to have on negotiations. Let's see. I'm going to skip some of these. Okay, I think this is important. When you go out and for your pitches, right now, because you're so early, the maximum amount of money that I would, put for a potential fundraise, and this is like doing something like this very professionally, it's asking for a maximum 500K would be like the maximum amount that I would put there. Although in this case, I mean, actually, is there a prize, Nicole, on how much the winners are gonna get?
Yes, they will get a computer.
Okay, they'll get a computer. All right. So never mind. So maybe, but if you decide to go out and raise money from investors, right now that you're so early and it's pre-prototype, pre-everything, the maximum amount that I would request is $500,000. If you're gonna do this professionally. Okay. If not, you probably don't even need to put it there right now. But just remember that the more cash that you ask for, the more you're going to get diluted. The more, if you want more, you need to give up more as well of ownership, right? So if right now you own 100%, you need to give up, a bit more if you want that money to come in, just like in Shark Tank. Okay. All right. We're going to get into something extremely important. And I know you've probably seen this in or you're going to see this graph in one of your other sessions. But the size of the market, as you put this together, this slide is extremely, I'm going to say it again, extremely important if you go out and try to fundraise from, professional investors. And the reason why is ideally you need this market to be huge. The smallest it can be is $1 billion. And I'll explain that in a second. But ideally what you're showing here is that you're gonna be competing in a very large market, right? Of course, with a type of, but the focus of your startup right now or your idea should be something very smaller and niche, right? So let's say I'm gonna be competing in the shoe industry. So the shoe industry is probably, I don't know, like, I'm making up a number, but it's probably like $200 billion every year because everyone buys shoes, right? However, what I'm selling right now are custom shoes for, steel toe boots. So that's a smaller part of the industry. And furthermore, they are, I'm going to make something up. These boots these boots also have some sort of lining that make them extremely comfortable, right? So I'm only servicing a smaller part of this market, right? I'm not going after the $200 billion market, right? But I'm shooting for something smaller, right? I'm shooting for maybe maybe industrial companies, right, that have a need for this type of boot. And so right now I'm only going to service a small portion of that huge shoe industry. And this is called the serviceable it's the serviceable addressable market, right? The steel toe shoe addressable market. And with the resources that you have, because you're starting off small and you can only focus maybe on one region, or you can only focus on, certain cities. This is going to be called your serviceable obtainable market. This is where you can actually compete and what you think you can actually win, right? The idea behind this and the reason why you need to show the obtainable market, the addressable market, and then the total addressable market is that it can show investors that it's an industry or it's a market that you can grow into, right? As a startup, you always need to focus on something small where you can win, be very differentiated, a niche, right? And then over time, okay, with more money, maybe you can grow and start competing in bigger parts of that big market. Now, why does this matter? And I'm going to show you, I'm going to switch, I'm going to put another Excel because we're going to go through this together. And this is why the size of your market matters so much. Share, there we go. Okay. Can you folks see my Excel?
Yeah.
Awesome. Thank you. All right. So I'm going to give you, this is how investors think about this. This is what we're thinking when you're showing us that slide and why it matters so much. So let's say in my case, I have a $10 million fund. 1, 2, 3, 1, 2, 3, right? $10 million fund size. Fund size. And I will invest in, I'm going to make this up, 25 companies. Investments. I'm going to invest in 20 companies. So 25 companies to make it easier. So that means that each one of my investments is $400,000. Okay. Now, I've told my investors that I'm going to make them investor return. I told them that I'm going to make them 4 times their money, right? So this times 4, right? So from 10 million, I'm going to make them $40 million. Now, let's go back to the very beginning, what I shared at the very beginning. Investing into startups is extremely risky, right? Where 80-90% of the companies that I invest in might go to zero. So what does that mean? In the investor's mind, every time we make one investment, we're thinking, can this one investment of $400,000 turn into 40 million over time? Okay. So that's how we're thinking about it. Like, do I think that this investment is gonna make me $40 million in 7 to 10 years? Okay, so that's why the bar is so high when you're trying to fundraise from venture capital, and why, ideally should be looking at angel investors early on. So let's say that, I'm investing 400,000 and you're going to give me, because that's typically what happens, I'm going to get about 20% of your company early on. Okay. So what that means is that your company, I'm investing, 400,000 out of a 2 million, this implies that I'm investing your company's worth, company value is 2 million bucks, right? If I do the 400, right? So your company right now is worth $2 million. That means that I need your company to grow. This what you would think. I need to grow a lot, right? Now let's think about it, if your company operates, let me go back to this. Sorry. Just looking at my numbers real quick. Okay. There we go. Power 20% stake. Yep, okay. So if I need your company to, my investment of 400,000 to turn into $40 million, that means that the worth of your company has to grow substantially from this 2 million to at least 200 million, right? I need your company and value to be 200 million. Because that's how my 20% will be worth that 40 million, right? Now, imagine participating or competing in an industry that's worth the $1 billion that I told you. That would mean that in 10 years, a small company, market size of $1 billion, right? That would mean that in 5-7 years, your company would have to be where we go. It would have to be 20% of the market. It means you would have to be like top 1 or 2 of any market to be able to reach that valuation. And how hard is it to be number 1 or 2 in any market? That's extremely difficult, right? So ideally, if you participate in a market that's bigger, right? There's a better chance, that you'll be, there's a better chance that you'll be able to make it and make me my money, right? Right. So if I go to a $10 billion, market, I only need your company to be 2% of that market, right? So that makes my life easier. So me as an investor, I'm hoping that your market is as big as possible, because then I'm like, okay, I can believe that in 7 years, this company could be 2% of that whole market, which is still difficult, right? So anyway, that's why, that is why this slide over here is so important. The size of your market, extremely important, okay? There's some slides here that talk about, what, more on the venture capital model and how the type of work that we do with startups. But I'm going to skip this. Go a little and how we do diligence and what we look at, right? So these should be good for you and some of the other sessions that you're doing. But let me move a little bit more into the finance part of this. All right. So Valuating startups, how much is your company worth, right? This is, it's going to sound horrible, but when it comes to the startup space, it's hard to be technical. You're probably, for those of you that come from a business background, you understand maybe what a discounted cash flow looks like. You understand what market multiples might be, right? You value a company based on X amount of revenue, X times revenue, X times, income, etc. In the startup space, it's much more rudimentary than this. And the reason why is because, as we saw a few slides earlier, you're probably not making money. You're burning cash, right? So we focus a lot more on the industry, the size of the industry, and then also doing a lot of, might seem weird, but literally it's back of the envelope math as to how we figure out how much your company is worth, right? So we look at something that's called the venture capital method. So what we do is that we reverse engineer a valuation based on the return that we want. Okay. So similar to what I showed you in that previous Excel, we reverse engineer things, right? We figure out this, if I think this company is going to be 2% of the market, well, it means that that's when they can reach a valuation of these $40 million, and that's how I make up, my money for my investors, right? So this is how we define and how we figure out valuations in startups, right? We'll look at the investment amount. We will multiply that by 1 plus the IRR that we're looking for on investors, similar to what I showed you earlier. And that tells us, okay, that should equal, this is the amount of money that I need to make at the end of the year. So I showed you already, let me grab this stuff. There we go. It's not annotated. This is okay. So I showed you earlier, I told you I would be investing, $400,000. I know that at the end, what I'm hoping is that 400,000 will turn into $40 million. And then we reverse engineer this part in between. Okay. Now, how much ownership is required, or how much ownership do I need? Based on the required exit, if I need to make the $40 million, and I know that your company is going to be, should be worth, the 20 million that we estimated, 200 million that we estimated earlier, well, that gives me my ownership required. So this is how we negotiate, how we value the companies. And you're going to have, of course, these slides, but it's basically the example that we went through live on the Excel. Okay. Now, this is also really important. How do you keep track of how much your company is worth? And so this is some valuation jargon that you should take with you. So there are different definitions here. The first one is pre-money valuation. What does that mean? Exactly, literally, it's very literal. So it's, what is the value of your company before a new round of money comes in? So let's say right now, if my company is worth 0 and I'm raising $500,000, well, my post-money valuation is $500,000. Then that becomes your pre-money valuation when you go out into the world and raise some more money, all right? So pre-money valuation, post-money valuation, and ideally what you're hoping every time that you go out and fundraise money is that you'll have an up round. And that means that the share price that you'll have will be higher than the previous share price at the previous investment round. Now, how do we come up with a share price? Okay, every time when you launch, if you launch a startup, if you do it, if you do this professionally, right? You'll create a document where you come up with, these are the initial amount of shares that I'm going to have, that I'm going to distribute with my co-founders and whatnot. And you're going to have to determine a share price for that. At the very beginning, I mean, you might say, hey, we're putting, and then I'm oversimplifying, but 100,000 shares, and we're putting up $50,000 between the two co-founders. That means that each one of my shares is worth $2. Okay. Well, when you go out to the market, this is how you'll define, your share price. Of course, well, that initial share price, it will be that pre-money valuation divided by your pre-money shares, and then post-money valuation over post-money shares. We're gonna do a couple of exercises here on how to determine and calculate a share price. Okay. So here's an example. An investor decides to invest $5 million for 20% ownership of a company. So let's figure out what the pre-money valuation is, right? So, okay, what is the value of the company before that $5 million? And also figure out what the post-money valuation is as well. Okay, so we're going to walk through this together. So, things that we can fill out. First off, okay, we know that the total money invested is the $5 million. Okay, that goes here, that goes here. We know that the VC wants 20%. Okay. So from these two, we can reverse engineer and figure out what the post-money valuation of your company is, right? So now we know that, if I then divide 5 million by 20%, that should give us $25 million. So now that it becomes my post-money valuation. And if I know that my post-money valuation is 25, and I know that the investment amount is 5 million, 25 minus 5, that's going to be my pre-money valuation. And I know I'm going a bit fast on some of these things, but you're going to have the resources in these slides so you can, try this out yourselves. Okay. Okay, let's go into a different example, thinking about the investor side. So here you understand your finances. Okay, this is what my company's worth before the investment and after the investment. Let's look at the other side. Let's look at, let's think about you know what, I'm going to skip this example because we've already done one live. But it's the same methodology that I showed previously when we went through the Excel. Okay. Okay. Let's see. Skip this one as well. Okay. Okay. Now that you understand or have, we've gone through a little bit on how to determine the share price of your company, the valuation of your company. What are some of the financial, or what are some of the indicators that we care about as investors, right? So when it comes to how you track the finances and the operations of your business, right? So we look at things called unit economics. And we'll get into that in a second. So we're going to look at KPIs and unit economics. KPIs is how you track the operations of your company, how well the company's doing, what are things you need to improve on, right? And these KPIs help you, manage and make decisions about the business. What are things that I need to improve on? Are there any red flags? Are these things that we're doing extremely well? And there are different types of KPIs, right? So these indicators, they might be financial, they might be operational, they might have to do with sales metrics and whatnot, but they help you monitor the health of the company, measure any progress, and of course, make any adjustments and stay on track. So defining KPIs for the type of business that you're hoping to launch will be super helpful. So for example, an example for the first business idea that was given, maybe, what does success mean for the company? Okay. Can mean how many students utilize the service, right? So, and how much money am I investing per each of these students that's crossing, right? So if I know that operating this is going to cost me $20,000 a month, right? And I have 20,000 students that use this during the month, that means that it's costing me $1 to operate this. So, and you can become more efficient over time, right? As you become better, you say, hey, now instead of having 20,000 students, now I have 25. Oh, that means my cost per student to operate this model is going down. That's a good thing. But if it's going up, I need to make some adjustments, right? So depending on the type of business that you have, you need to define what KPIs and what success means. And that is going to be extremely important for the finances and how we assess, your company over time. Okay. These KPIs I mentioned can be financial. They can have to do with recurring revenues, profit margins, the burn rate, of course, that we already spoke about. Can be about sales, marketing, and whatnot, right? As I mentioned, they have a strategic objective, and they should help you, identify, what the red lines or what the red flags are for your business. Okay. Okay. One of these very important KPIs, and that I think we can generalize because this is a financial one, and we all use it. It's called annualized run rate revenue. You can also call it annual recurring revenue. People call it either way. But in simple terms, basically what this is in your last month of operation, let's say you made $50, you multiply that by 12. This shows investors what the current state of your company could be if I turn it, instead of a monthly operation, to an annual operation, right? So maybe previous months you were making $10, $15, $20, but this month, because you've closed new contracts, because you have made certain, improvements to your marketing, etc. Now you're selling 50, right? You multiply that by 12, and that turns into your annual recurring revenue. Now, why is this important? In investor world, there are different thresholds in terms of how much annual recurring revenue you need to hit to be considered for investment. Okay. So to raise for example, to raise a seed round, for example, right now if you raise money, you're in a pre-seed basis. So it means you're still ideating, you have a prototype, etc., but you're probably not making a lot of money. But when you start to operate and you start making some money, you need to hit a threshold of about $1 million in ARR for investors to even bat an eye, to say, okay, I'll analyze your company and see if I want to invest. Okay, so you need to de-risk and grow the company enough that you're making $1 million in ARR, which if you divide it by 12, can anyone tell me how much that is? I don't mind uncomfortable silences, so I'll wait.
I'm not sure if I'm right, but would it be 83?
Yeah, that's right, $83,000. So it's hard, but it's not terribly hard to be selling $83,000 on a monthly basis, right? And then you start to become interesting to investors. So yeah, that's exactly how you reach that. It's 1 million divided by 12, and that's how much you're selling on a monthly basis. Okay. So what we were talking about just explained here, so you'll have that as reference. Because what's happening between, not making any money and making those $83,000 on a monthly basis, you've been trying things out, right? You're improving your sales. You're trying to figure out what sales channels work. You're trying to figure out how much it costs you to get a customer. You're doing a bunch of things, right? But these you can call them these learning moments. Get you to a place where, okay, if you're selling between $83,000 and $100,000 on a monthly basis, people know that, oh, well, they've got something real here. I mean, it's not very big, but at the same time, it's still meaningful. I mean, selling $183,000, $100,000 on a monthly basis, that means you have a real business, right? And customers like you, and they're willing, to pay you some money and stay with you, right? So that's why it matters, right? It signals to investors that you're learning and that you have a repeatable business model. Okay. Other KPIs that I'm sharing here, some KPIs based on different stages of a business and based on how much time you've existed and how you should grow, right? What it means over time to be doing well. So we have an indication as to when you can go out and raise some more money. But right now in the early stages, focus on getting your business to an annual run rate revenue of $1 million. Okay, these will be here for your reference. Another important part to this is, yeah, you might be selling money, you might be bringing customers on, but equally important is churn. And churn means how many customers are you losing? So let's say this month this month I brought on board 20 customers, but I lost 5. So that means that net I'm bringing on board 15 customers, right? And that matters, right? Because it's very different to bring on board 20 customers and lose 1 or 2 than bring on board 20 customers but losing 5 or 6, right? So churn is a metric that you really need to track, because it will tell you, if your customers actually like you and what's the likelihood that folks will stick around. And it'll give you a sense of, hey, these are things that I need to improve. These are things that I need to change, right? In a software business, these are the churn percentages that you should be aiming for. This is different, in other types of businesses. So this is SaaS, which is, software as a service. Churn rates for products or physical goods is very different, tends to be higher, right? But this is important for you to track. And the good thing is that you can find churn rates for each industry online, right? So what are the benchmarks for your company being good, great, and what is bad, Okay, so you can find these, but just take away churn is very important. Okay, because that gives you your retention rates, right? I've given you here some if you know your churn, you also know what your retention is as well, right? These are also some benchmarks you should be shooting for, right? And now I'm gonna wrap up, with looking at unit economics. So unit economics, we went at the very beginning, we were talking about you're burning money every month. That doesn't mean that your core operation should be bad, right? That doesn't mean that it's bad. It just means that you probably need more money to scale, right? And there's a difference between your core operation versus your whole operation, right? So these are some definitions that really matter for entrepreneurs as you're thinking about your finances, right? Because in startup world, we're not looking at net income. We're looking higher up, right? We're looking at your operating income, right? So everything that comes before your managerial and administrative costs, right? So a way for us to assess that is through these different indicators that are called unit economics. So first thing we look at here, I mean, we have variable contribution margin, which is revenue, the revenue per unit minus the variable costs per that unit. So let's say I'm making a widget for $5. The cost of the materials and to produce that widget, it cost me $3. So that means 5 minus 3. Okay, my variable contribution margin is $2, right? Here I'm just looking at variable costs, okay? That matters. Contribution margin will be my variable contribution margin, my VCM, in total that I'm making for the business, minus allocated fixed costs. So let's say that widget, that is making me $2, I need to allocate certain fixed costs to it. Maybe part of my rent, part of my salaries. So that's going to be my contribution margin, right? How do I do this? Let's say I'm making 100 widgets, right? So that means that my total variable contribution margin is 200, right? Each one is making me $2, so 200. And then I have, I have fixed costs of $50. So that means 200 minus the 50. My contribution margin is $150. Okay. Fixed costs, and I mean not to hammer too much, but fixed costs are the costs that you're going to have regardless of the amount of units that you sell of your product, right? So this will mean your rent, this will mean the machinery, this will mean your salaries, right? All of these fixed costs that you can't change if things are going well, then don't change much if things are going really well or really bad, unless you're scaling, right? And you have to buy more equipment. Okay. Churn rate, I think, well, we already addressed that, but it's customers leaving divided by total customers. Lifetime value. This is really important as you scale your business and you start to operate and track how many customers you have and how many of them are leaving. You're gonna try to define what's called a lifetime value. And what does that mean? A lifetime value is how much money will this customer make me? How much money will this customer make me during the time that they're that they're with me, right? So, for example, I'll give you an example in banking services. It's normal for a customer to be to have the services of a bank. So let's say Wells Fargo. It's typical for a Wells Fargo customer to stick around for 5 years, right? So 5 years. In those 5 years, how much money am I making off of that customer? Okay. That's basically what you're trying to get to, right? This is a way to calculate it. If you go on the internet, there are different ways to calculate lifetime value, but the essence is how much money can I make from this customer while they're still my customer? So let's say it cost me 200, I can make $200 from them over 5 years. That means, I'm making what, $40 on them on an annual basis. That lifetime value, we tend to compare it to customer acquisition cost, which means customer acquisition cost is how much money did it cost me to win that customer over. So how much marketing I had to spend on these folks, how many ads, how many client visits, how much did I spend on acquiring one customer? So if lifetime of value is higher than your CAC, that is good, right? The higher that division is, the higher the result of LTV divided by CAC is, the better you're doing it, and the better your business is. So part of what you're trying to do while you're operating is maximizing LTV divided by CAC. All right. I have some examples here that you can run through to go through, how to calculate each one of these, and giving you examples as to how, different companies do it. So hopefully you'll be able to take this away with you as reference. And I've tried to put different types of companies here, from software to hardware to physical goods. So hopefully you'll be able to calculate this on your own as well. But just hammering the point, if your customer acquisition cost is higher than your lifetime value for a customer, you're going to die as a company. Alternatively, means you're going to live, because it means that your main operation, core operation, is sound, and it's going to be easier for you to, raise money from investors. Let me skip this. And yeah, think right on time. 2:31. I know a lot of content. I know it's a lot of information, but I'm also available as a resource if you have questions. If there's something specific that you want to review, happy to help. Nicole and the team, they have this presentation, and if the team doesn't, happy to resend it. Any maybe questions or any thoughts, before we part? And I don't want to go over too much in terms of time. I think I probably made them dizzy, Nicole.
No, can you hear me okay?
Yeah, you're perfect.
I have the sound coming from my phone. I had to set up different here. But anyway, no, that was fantastic and very thorough. I see some clapping, some rounds of applause here from some of the students that's coming through. So it looks like it was very beneficial, very thorough. Students, as Alejandro said, a lot of information, but I hope you benefited from it. Any comments or any questions? This was a lot of information, so please don't hesitate. Somebody else might be thinking about the same question that you have. Okay. Any comments or any questions from the institution, the different institution leads?
No, just to say thank Alex. Thank you so much for your presentation. We really, really appreciate it a lot. I'm sorry I had to turn off my camera, but I was running out of battery. So I really appreciate it. Nicholas, if you can send me the presentation so I can forward it to all the students and they can benefit from all of this knowledge that Alejandro has shared.
Yes, absolutely. Alejandro, it would probably be helpful if you just brought it back up to my inbox, if you
Yeah.
don't mind, to the top of my inbox. I have it, but I'd have to do a search for it. So that way
No
I can
worries.
get it to the team faster.
I'll on the email that you just sent, I'll reply to that.
Perfecto. I just want to check the chat really quick to make sure we didn't miss anything. No? Last chance, team. If you don't feel comfortable turning your mic on, you can drop your question or comment in the chat. No. Okay, just a friendly reminder to everyone. We announced it at the beginning, but next week's session, the time has moved to 2 p.m. So please remember, next week we will be logging on for our final workshop at 2 p.m. Kathy, anything else on your end?
No, just to make sure that if students have problems with their teams or they have any questions, to reach out to each of the institutions, the advisors, so we can coordinate and have fun, everybody. I think this is also meant for you guys to enjoy and have fun.
Thank you. And Alejandro, thank you so much. We greatly appreciate your time and your commitment to student success. So thank you.
No, thank you.
Alejandro.
And thank you both. Thank you all for the time. And I just sent that over to you, Nicole. So you'll be able to share it.
Perfect. I'll hit forward
Right.
on that. Thank you, everyone.
Nicole,
Yes.
Thank you
Nicole,
so
can
much.
you also send me the presentation from Carlos? Because we have the video, but not the presentation. So if you send me
Perfect.
both, I'll send it as a blast to all the students.
Okay, that sounds great. Shasta, are you still on the call by chance?
She was until a few minutes ago.
Okay.
But maybe she
No, that's
left as we were wrapping up.
Okay, not a problem. I will definitely get both over to you. Bueno, pues, thank
Perfect.
you, everyone. Have a great
Take care.
weekend. Thank
Have a
you.
great one. Have a great
Bye-bye.
weekend.
Bye-bye.
Bye.